All right. Today's Sunday, the 6th of October. This is a recap for the stock market activities for the week that was and an outlook for the week to come. And folks, I got a good one for you tonight. And I got some good news for you. Your boy's vision is back. I can see like a bald eagle right now. Matter of fact, I think I developed a superpower. Now my vision allows me to see everybody naked. Doesn't matter what you're wearing. I'm seeing you naked right now, which could be a really appreciated superpower if you're in Pacific Beach, San Diego. But if you walk in a Walmart in the middle of the country, you probably wish that you were blind. Anyways, of course, everybody's now awaiting the Israeli response to Iran. What's going to happen? Are they going to hit the nuclear facilities? And most importantly for us, investors, traders, for the global economy, for the markets, are they going to hit Iranian oil facilities or not? I mean, hitting Iran in any aggressive way is a bad outcome to begin with, because the prospects of escalation and retaliation will put the market on edge, and of course will spike up crude oil prices, because the speculation would be, even if there is no strike right now on the Iranian oil facilities, depending on the aggressiveness of any strike really, and the retaliation that will come after, the market will be on edge. And of course, the number one commodity to look at is crude oil. Now, folks, we're going to do our macro and geopolitical coverage Monday, because that's the new schedule that we got. If you remember, a few weeks ago, we talked about splitflation. So we're going to do the market coverage Sunday, the macro coverage Monday, and that way we're not producing an hour and a half worth of a video on Sunday night. So that's going to be the discussion for tomorrow. And I'm hoping that if the Israeli Mossad is listening, you might want to wait till you hear my analysis first before you do the strike. And please don't explode my phone. Anyways, folks, when we talk about crude oil and the prospects of a spike in the price of crude, which will lead, with no doubt at all, to a spike in inflation again, we have multi-tailwinds. It ain't just the strike on Iran or the geopolitics or the war in the Middle East. It's also the Federal Reserve cutting rates, making a huge mistake, 50 basis points. They fell into the trap, even though the economy does not need the 50 basis points rate cut. Now the Federal Reserve has ensured that inflation will come back. And the other tailwind, of course, comes from the stimulus in China. So even before the strikes by Iran and the anticipation of a retaliation by Israel, we already had solid and strong tailwinds for crude oil to go higher. But it didn't play out right away. The skeptics, and I should call them the propagandists really, they continue to hammer crude oil by false news and issuing downgrades, such as Wells Fargo, for example, saying that oil prices will stay depressed through 2025 from global oversupply. They said that back in September 25. Now, Wells Fargo, all what you need to know about Wells Fargo is if you walk to any branch of the bank, unless you're cashing a welfare check, you have no reason to be there or bank with them at all. The reality is, as we see escalation in the Middle East, the true analysts of the market, not the propagandists, who want to push the price of oil down before the elections, anticipate that Brent oil will skyrocket to $100 a barrel, if not even more. I've read as much as $200 a barrel if we have a wider escalation in the Middle East war. And it begins with Israel hitting the oil facilities in Iran. Now, of course, folks, the manipulation efforts are not going to stop. The latest being on Friday before the market close, we got a conference by Joey B., the former president of the United States, in his gray suit. And he had one job: to manipulate oil prices down before the close. Why? Because if the traders speculate on a strike by Israel over the weekend, they're going to buy way out of the money call options, betting that crude will go higher. And in response, the market maker comes Monday will have to buy a lot of shares of the commodity and its respective ETF, which would have pushed crude prices higher upon the open on Monday, strike or no strike. But he came out and said, if I was Israel, I would not hit the oil facilities, Jack. I would just leave them alone. And immediately you can see the impact. Of course, crude oil rallied throughout the day, from the lows all the way to the highs, by about 2.5%. Then came Joey B. with the manipulation comments and caused the weak hands to get out, which pushed the price down and ensured that at least Monday upon the open, we're not going to get a squeeze unless, of course, the strike happens before the market opens. Now, the speculation is that Israel wants to do the strike during prime time here in the U.S. because there's a message to the U.S. from these strikes. We will see what happens, but again, this administration is so desperate to just patch everything up right before the elections. And you gotta wonder why. All of this manipulation, last-minute interference, I mean, you saw what happened with the ports. We got a strike. Then behind the scenes, they promised sweetheart deals with the unions that if you extend the negotiation period all the way till after the elections, we'll give you something better. And the question is why? What are they afraid of? Why do they want to manipulate the markets higher and just patch up the economy right before the election? And then what are they going to do? After they get your votes, what's going to happen? Are they going to screw all of us and perhaps give us a second wave of inflation, if not a stagflation crisis in the economy? Again, the question goes, why do they keep doing this manipulation effort? Day after day after day. What are they afraid of? Go down in the comment section and let me know. But it goes hand in hand with the data that we got on Friday. We were anticipating the payrolls, aka the jobs report. And again, if you know anything about this administration, it doesn't matter who the face of the administration is, Biden, Harris, Buttigieg, whoever the hell it is. I'm talking about the folks who actually rule the country behind the face. If you've been watching what they've been doing throughout the year, and even before the year began, manipulation after manipulation after manipulation, to keep everything intact before the elections, you would have known right away that there is a snowball's chance in hell they will give us a weak jobs report in September right before the election. It's not going to happen. And listen to this. They gave us 254,000 new jobs created in the month of September. Expectations, 140,000. Now, we can talk about the largest seasonality adjustment on record for this reading. We can talk about the 700,000 plus in government jobs created in September and how that swayed the number higher. But we're going to do all of this in our macaroni coverage tomorrow when we do the macro and the geopolitics. In this video, we don't really care if the number is right or wrong or implications in the economy. We don't really care about any of that. We care about the implications on the market, implications on the investment strategy from this point on, given the really important piece of data that we got on Friday. Most of you know that we are right now, at least according to my analysis, we are in a period that I call walking on a tightrope. The assumption is that the Federal Reserve cut rates by 50 basis points, and they're itching to cut more. And inflation been heading down, so the assumption is right now we have a soft landing assumption, unless one of the winds, the inflation wind or the recession wind, knock us off the rope. And it's just a matter of time before that happens. But every piece of data now becomes really important. I mean, you might have noticed that a lot of brokers right now offering gambling on economic pieces of data. So before the jobs report comes out, is it going to be a beat? Is it going to be meet expectations or below expectations? You can bet on that. That's how insane all of this has become. But this is the market that the Federal Reserve wants. The market should be based on the earnings and corporate numbers. It shouldn't be based on what we speculate about the Federal Reserve policy. That is not a free market. But every piece of data either strengthen the pace that the market is now walking on this tightrope, or strengthens the recession wind, or strengthens the inflation wind. And you see the market shifting themes based on all of this, based on the data. Now, one week you have one theme, recession theme. Then the next week you have an inflation theme. I mean, think about the theme that we've been having in August all the way to September, the recession theme, where the dividend-paying stocks and the defensives outperformed. And now, just this week, it was an inflation / a geopolitical theme, where energy was the number one gainer. So this is going to be a really important conversation that we're going to have, and you need to understand this as we head to this next period of stock market investing, which is going to be really challenging. As I said, we're going to sway one way or the other based on the flow of the data. And now that we're done with the employment report, we do have the CPI and the PPI coming out this week. Now look, when the report came out, we're talking about the payrolls now. I said if we have a big beat on expectations, the 140,000 jobs, and we have a higher hourly wages number, which we got, I don't think the market will be happy about that, because it will say that the Federal Reserve will probably not do any more cuts from this point on. Perhaps they've made a mistake or got trapped by the manipulation of the data and the pressure from the politicians and the banksters to do the 50 basis points rate cut before the elections. And now this data says that there was absolutely no need for 50 basis points rate cut at all. Needless to say, the market, at least the algorithms that are trading the market in the pre-market session, loved it. And we've seen a big pop in pretty much every index. The SPY, the Qs, the IWM, the small caps, even though bond yields exploded higher, indicating that the Federal Reserve will indeed perhaps not do any rate cuts in the next meeting. Of course, the next meeting happens after the elections. So if you wanted the Fed to manipulate interest rates before the elections, you give them a little bit of a weak data heading into the last meeting of September. They freak out, they cut rates by 50 basis points, then you say, whoops, we're revising all of these numbers up again. Now we secured the cuts, we have no more Federal Reserve meeting, we need a really good number before the elections. Boom. Can we trust any piece of data, folks? Any piece of macroeconomic data coming from the government? Who the hell knows what the reality of this economy really is? But in any case, I gave you a morning brief on my Discord and said, look, I'm not really buying this. The fact that we're pumping everything higher, especially like the IWM small caps, when we have bond yields exploding higher, I'm actually going to take a trade right off the gate, betting on a pullback. And I'm going to buy the dip in crude right away. My message was, in a nutshell, I'm not sure about this reaction. I think there's perhaps a trap in it, given the fact that bond yields are higher. But at the same time, do you really want to fight the algos? So again, do your homework before you get in. And I did a trade right away. IWM, here it is, 6:44, about 15 minutes after the open Pacific time. We bought a bunch of contracts, put contracts on the IWM in a series of 200 contracts each. Closed them about 10 minutes later for a nice profit. In, out, hello, goodbye. We're done for the day. Made over 10 grand within the first hour of the day. Goodbye. See you later. And you see other traders here, really happy to see this. Other traders also did about 6K in the morning, 15 minutes or less. A lot of folks made thousands of dollars in about 15 minutes, 20 minutes, and then gone. Go back to bed. I'm not a day trader, but when they give you an opportunity on the silver platter, as they did on Friday, you gotta take it. And that's your hooker money for the weekend. Unless you live in Cincinnati, then you only need $200 out of that, and then you're gonna spend the rest on penicillin shots. But we go back to the tightrope strategy, folks. With the jobs report, doesn't matter whether you like it or not like it, agree that it's fake or not fake, or whatever you think about it, that doesn't matter. The number itself right now, huge job creation pace in the month of September, unemployment rate goes down. What does that do to the recession risk, at least right now? The recession wind, shall we say? The answer is it diminishes. What other two dynamics strengthen? The answer is the tightrope and the inflation wind. So when we go back to our strategy, again, this is just the strategy that I'm following as of right now. We said we stay long but hedge the defensive stuff, the value, the dividend-paying stuff, the utilities, you know the deal. And then we have the pick category. In the cyclicals, you pick what you like, but then you have dollar sensitive and yield sensitive. Dollar sensitive, so long as the dollar is going down, we like those, even though a lot of these guys outperformed despite the dollar going higher. We'll talk about that in a minute. But then you have the yield sensitive stuff like the small caps, the regional banks, the biotech. And on Friday, at least, all of this stuff went higher despite the fact that bond yields went higher. But we're going to look at the week all in all. And you'll see something really interesting in a minute. That we have the rent category, which is the AI mania, the big caps, depending on the charts. For example, Microsoft wasn't looking good. You probably wanted to play a pullback on that. Google Meta looks pretty good. Maybe you want to play more upside on that, depending on the charts. We might shift in this category, by the way, back to shorting them again, depending on whether we get any confirmation whether Friday's reaction was for real or was it just a fake out. So once again, this is the strategy and it's going to shift. The pick could be sell. The long but hedge could be something else in the upcoming weeks. But at the end of the day, I want you to think about it this way. What is the rope? The rope is the soft landing theme. In it, of course, we have cyclicals, retail, transportation, small caps, profitless companies, regional banks, biotech, home builders, construction, and commercial REITs. A lot of stuff in the soft landing theme. And based on Friday's action, it got a tailwind, even though the headwind is the dollar and bond yields went higher. So it depends on how you look at it. I look at it as, yeah, I can't really go with the small caps if yields are going higher. Some other folks would say, I can go along and stomach it because higher yields mean better economy, whatever bullshit spin you want to put on it. What is the inflation wind theme? Energy, commodities, metals, China. What is the recession wind theme? The dividend-paying stuff, the bonds, value stocks, healthcare, real estate, staples, defensive stuff like McDonald's, utilities, and gold. Which theme has been dominant so far? Because you can tell me, hey, we have the headlines on Friday all over the media. Soft landing, soft landing, soft landing, soft landing. Nobody talks about reinflation at all. I'm just going to let the market speak to what it's really thinking. Because, of course, based on Friday's data, the market action was, hey, the recession wind diminished dramatically. So we've seen dividend-paying stocks, bonds, value, real estate, healthcare, the staples all going down. But the inflation went strengthened. So energy, commodities, metals, China, all of this stuff been leading. The rope, I'm not sure. The rope, we need to see more. Was Friday a fake out? Because bond yields went significantly higher, indicating that the Federal Reserve will perhaps not give us any more rate cuts all the way till the end of the year. Would that be really good for the profitless companies and the retail and the cyclicals and the small caps? I think there is a division. Some corners of the market say yes, based on Friday's action. Others disagree. So we'll have a question mark on it. Now I'm going to let the market speak for itself here, folks. We go back since the Federal Reserve decided to cut rates by 50 basis points. What you're looking at right now in white is the XME. This is the metals ETF. And in green is the IWM, the small caps ETF. Now, if we have a soft landing theme, then the IWM should be leading. But if we have an inflation wind, that's what the market really thinks, then the XME should be leading. And guess what? The XME, since the Federal Reserve began cutting rates by 50 basis points, is up over 6%, while the IWM is down more than 1.5%. At least so far. This is not me saying it. This is not the propagandists in the media who are all talking about soft landing right now. The market says, I see inflation risk. I don't really see soft landing right now. Maybe that's going to change into the week based on the data that we got on Friday. And we see the IWM taking the leadership again. I'm not going to go ahead of myself right now. But I'm just saying, since the Federal Reserve cut rates, the market action speaks loudest. And it says, I'm going with metals. I'm going with the inflation theme. The soft landing theme, I'm not sure. Now plug in the XLE, energy. Since the Federal Reserve cut rates, energy also up over 6.5%, outperforming the soft landing theme of the IWM small caps. Since we began talking about the Federal Reserve cutting rates by 50 basis points, if you look at the 1 month performance of commodities, absolutely incredible. Natural gas up over 18.5%, sugar up over 17%, silver, copper, soybean oil all up over almost 10% apiece. The WTI, Brent up by 9% apiece, gasoline up, meats, grains, everything you look at, any commodities are big since we began talking about the 50 basis points rate cut. Again, not me saying it, hey folks, reinflation risk is now becoming reality. The market is saying it. The market action, the pricing of commodities is saying, hey Fed, you made a huge mistake here. All what you're going to get is a revival in inflation. Take your soft landing headlines and shove them back in your butts. Not going to work out. Soft landing is only ensured after inflation is defeated. And inflation has not been defeated yet. What's important for us investors at this point? How do you rotate your portfolio at this point? What you're looking at the heat map right here is the 3-month performance of the stock market. Now, there are a lot of folks who are just too lazy. I'm just going to stay in the big caps and the index level. I'm going to have the SPY, the SPX, the Qs, the NASDAQ, and that's it. Well, for 3 months right now, you underperformed because the big caps are down for the most part. The chip/AI mania down for the most part. The stuff that outperformed during this period is China, oil, commodities, the defensive stuff, the dividend-paying stuff like utilities, real estate, staples, the industrials, the cyclicals, the banks, healthcare, and even within technology, software and cybersecurity been pretty good. We've talked about these themes before, so the market is thematic, as we talked in last weekend's video. And it's your job as an investor to follow these themes based on the rope analogy and the flow of macroeconomics data. Now, a lot of folks are saying, can we move significantly higher at the index level in the S&P or the NASDAQ? Well, that depends on one thing. You see these gains elsewhere in the market besides the big caps and the AI mania. Either we're going to see a massive rotation back into the AI mania, including the big caps. In that scenario, it doesn't matter what the rest of the market does. But in that scenario, if the AI mania and the big caps spike significantly higher, you will push the index level higher, no doubt. Or even better as a scenario, if we see participation of the big caps without a rotation from the winners that you see in the map right now. Well, gee, what would that take? It would take a lot of folks on the sidelines to hop back in. You need to give them an incentive to hop back in. Was the jobs report what these folks been waiting for? I don't think so. In other words, if we get stuck here, we see some profit taking from, let's say, stuff that went way too high, like the Walmarts or the Home Depots, the McDonald's, the real estate, the utilities of the world. But there is no rotation or new inflows into the big caps. Then the market will be stuck, if not head lower. So again, you look at your performance at the index level. If you look at your retirement account, for example, it's been flat for a few months now. But had you followed the China theme, for example, you're up about 50%. If you followed the utilities theme, you're up over 20%. If you followed the reinflation theme, you're up about double digits territory. And this is why using the themes is really important. I mean, you look at the Mag 7, 30% weighting in the S&P 500. In the second half so far, they only contributed to about 2.9% worth of gains. Two messages from this finding right here. Number one, thematic/active investing. Really important. Number two, it is certainly a more exciting market than what we had in 23 and the first half of 24, when it was all passive investing bullshit based on the AI bubble. Now we have things opening up, meaning the market is actually getting better. But that's not being reflected on the index level, which has been stuck for a while. Why? Because of the high dependency on the big cap technology companies and the AI mania. And those are about to face a real test with the earnings season for the third quarter, which a lot of these companies, Nvidia, Dell, and doesn't matter which one you look at, will face the law of large numbers when you pin their earnings for Q3 of this year versus Q3 of last year. It's going to be harder to beat. It's going to be harder to produce the triple-digit worth of gains in revenues and net income as they used to. In other words, we might be entering a period right now where thematic/active investing, and I think we're already in it, by the way. I've been saying this for months now, that thematic/active investing beats passive investing / the big cap AI mania bullshit. A lot of these companies are already fully priced, and we might actually short them at this point while we migrate to other long themes. I mean, you see the news that you get from a lot of these AI chip executives dumping hundreds of millions worth of shares. Whether you want to talk about Nvidia or Micron or AMD, they're just dumping insane amount of shares, cashing out. Even in the big caps, I mean, you look at Apple, investors are being told by the dog analysts from the Wall Street firms that, oh, don't worry about the iPhone shipments and demand. You got to stick and buy Apple. Meanwhile, the insiders, the CEO, is dumping $50 million worth of shares. We also have questions about spending. I mean, you look at Zucchini and Meta. In 22, the spending on the metaverse insanity absolutely ruined the margins of the company, and we've seen the stock crashing. Zucchini decided to back off. The stock recovered. Now he's going back at it again. With the stupid glasses in the metaverse, wait till Israel hacks into your glasses and make you walk off a cliff. I think all of this AI spending and metaverse spending will hammer these big caps where they become stagnant, if not head down. But other themes begin to open up. You look at Chinese equities, emerging market equities versus U.S. equities, really cheap. I think a lot of managers are now migrating and rotating out of U.S. equities into emerging market equities. And the reason is we have China stimulus, we have devaluation of the dollar by the Federal Reserve. The only problem is if we have a spike in crude oil, then that's going to stop and halt the migration back to emerging markets because it's going to be an added cost to China and all of these markets. Now, when we talk about the themes, folks, it's really important for you to have broad coverage in good themes in your portfolio. And I'll tell you why, and I'll explain to you what that actually means. Let's start with why. The reason is we have a shift from theme to theme to theme, week after week after week, based on the fluctuation of the data, which makes the market really challenging. And if you're just stuck in the index level, you're flat. If not, you're probably going to head down in the next few weeks. And if you follow the wrong theme at the wrong time, you're paying dearly for it. If you're following the right theme at the right time, you're getting rewarded handsomely for it. So that's the why. Now, what are the themes? How do we deal with them? I mean, you have the China theme, you have the soft landing theme, aka the rope. You have the inflation theme, the geopolitical theme, recession theme, AI theme, financial theme. And some of these themes overlap. And maybe one week we have a China theme. Next week we have geopolitical theme, as we got this week. And the week after we have an inflation theme. And the week after that we get another piece of data and we have a soft landing theme. So picking the overlap gives you broad coverage to multiple themes. And you can see that these kind of assets has been the outperformers as of late. Think about, for example, the China theme. You have the ETFs like the FXI, GXS, Alibaba, Pinduoduo, all of these pure China exposure. But then you have an overlap with the inflation theme with metals and agricultural names. They move higher based on an inflation theme, reinflation that is, or the China theme. Then you have oil, which works in four themes: the China theme, inflation theme, the geopolitical theme, and the soft landing theme. You look at gold. Gold works out in the recession theme, the geopolitical theme, and even the soft landing theme. And this is why you see gold, metals, oil outperforming pretty much everything, because they work in different themes. If you look at the soft landing theme, the overlap with the China theme. Certain retail names like Starbucks and Nike, I'm not a fan of that. because I told you before that yes, China could be a tailwind. What about consumer spending here in the US? Transport, industrials, but again, industrials been an outperformer, all in all. Then we have a really interesting overlap between the AI theme and the recession theme called utilities. Now that everybody caught up to the fact that building all of these data centers for AI will require a ton of energy, be it electricity or nuclear energy, now we see utilities being played as part of the AI mania. So think about what happened on Friday. We got a hotter jobs report. Bond yields went higher. In effect, the recession theme, the dividend-paying stuff, real estate, value, staples, healthcare, bonds, all went down. But utilities holding strong. And the reason is utilities has another theme that it belongs to now, and that's the AI theme. So as an investor, folks, it's really imperative for you to understand this, and you pick the overlaps. For example, I do like the China theme. I'm long the China theme. I'm long the inflation theme, long the geopolitical theme, long the recession theme. And I feel by that exposure that I got, with utilities, I got an exposure to the AI theme. With gold, I have exposure to multiple themes. And the same goes with oil and metals. That way, when we fluctuate from one theme to another, week after week, you're not losing your head. You have exposure to multiple themes. And that's really important to understand. Before we move on, let's talk about some trading that we've done, or we have some open trades for the week. I haven't been doing a lot of options trading because of my vision issue. You can't really trade if you can't see. But now we're back on track. But we do have some open trades that will require some management. If you've been following us on Discord, here's one of them, the MOS Mosaic Fertilizers. That's another theme that overlaps with a lot of stuff. We got the 25 calls expiration date October 18th. And if you look at the chart here, it's been going back and forth, consolidating within the 50 days moving average in blue. Now, if we take the lows, let's say at 26.25-ish, I'd be concerned about the trade, that it might go bust. But so long as we're trading here, we're just gathering the energy for another pop higher. You might have noticed this, by the way, it ain't just the fertilizers, or steel, or even gold. Despite the fact that the dollar went significantly higher this week, you've seen these metals and fertilizers holding pretty good, because the dollar is going higher as a result of the geopolitical theme. Only on Friday, we have introduced the fact that the Federal Reserve might not cut anymore. So we'll see how they're going to react. There is a lot of risk with the metals and gold holding at this point. I intend to own the stack if we, let's say, go higher, but this is a good point to book profits. And if you get another pop all the way to filling the gap in or around 28, I think that's going to be an ideal point to book profits and move on if you're not interested in owning the stack and exercising these call options. Then we have the XHB Home Builders. That's an open trade, 121.17, expiration date, the puts, of course, the expiration date October 18th. Now, really interesting that the XHB is perhaps one of the few sectors that did a true reflection of the fact that bond yields went higher on Friday. So if you look at the soft landing crap, like the IWM, the regional banks, they went higher on Friday. But the XHB Home Builders went down. Why? Because despite the fact that the Federal Reserve cut rates by 50 basis points, huge mistake, the 30-year bond yield actually went higher. In other words, mortgage rates went higher. Well, the whole point behind cutting rates is to lower mortgage rates and make things affordable again. Nope, all of the yields went higher. Your credit card rate went higher after the rate cut. Your mortgage rate went higher after the cut. Congratulations to the idiocy of Jerome Powell and company. So to me, this is a real reflection of what actually happened and should have taken place on Friday's session. The XHB Home Builder is down about 1.25% or so. We're going to look at the chart and the charts analysis and make a judgment about it. In the last one, we got a lotto ticket on Nike before earnings. We've done a calendar spread. Here it is, buying the 80 for the expiration date of the 11th, meaning next Friday, and then selling the 4th, which was last Friday. Cost us about 15 cents a piece, or $15 per contract. And if we look at the chart of Nike, it lost the 100 days moving average. You see those wicks in the last couple of days? It tried really hard to close above the 100 days moving average and it couldn't. So my 2 cents, we're probably going to go down to the trend line in yellow and then see what happens if we hold or not. If we go down to the trend line, I think the trade is over. You book the profits and you move on. Because understand that October 8th, that's Tuesday, we're going to have the reopening of Shanghai. And we might see a lot of pent-up demand that's going to shoot all of these China-related equities higher. So fingers crossed if we open Nike as we closed Friday, or better yet, a little more to the negative side, fingers crossed, we'll just book the profits here and move on. Or if you decide to keep it, understand that you got a risk with China reopening. And in that case, you want to have a hedge against that, and your hedge should be at least selling a covered put in this case, a debit spread, let's say 77.5 or 78, at least to capture your entry price, and that way you have nothing to lose. But with that, folks, we segue and add more color to this conversation. We segue to the market information that we got for the week, beginning with the closing of the indices on Friday. And here we go. The diamonds closing positive by 341.16 points, or a gain of 0.81%. The Nasdaq also positive by 219.38 points, or a gain of 1.22%. And the Spider closing positive by 51.13 points, or a gain of 0.90%. Even the small caps, Russell 2000, despite the fact that we have higher bond yields, managed to close positive by 3.02 points, or a gain of 1.4%. Looking at the sectors on Friday, the leader, financials, again, I say this is a theme on its own because you never know. Bond yields go up, maybe bad for the regional banks, but they go down, maybe good for something else. So financials have a mind on their own. I only trust the big Buffett, who's dumping his shares of Bank of America like there's no tomorrow. I think he sees a problem with the economy, and the problem will be concentrated in financials and the banks. So this is a theme that I don't like. Regardless, on Friday was the leader, followed by cyclicals and technology. The only laggard, real estate, but again, look at defensives, healthcare, utilities, anything of the dividend-paying / the recession wind was the underperformer on Friday's session. But we contrast the theme with the week. And off the charts, energy is the winner by far, up almost 6%, outperforming everything. And we've been talking about buying energy, be it crude oil, call options, or on the energy stock names. And I've seen on my Discord gains of 500, 600, 700% in a matter of 1 week. So it was a huge week for energy investor and energy speculators. The laggards, metals, the winner of the week before last week, or the week that we just wrapped up here. Why metals going down? You got to think about the dollar going higher. There was a degree of tolerance that if the dollar continues to go higher, at some point metals got to pull back. Real estate, of course, we talked about there is no need for the recession wind. If you have bond yields going higher, there's no need for the dividend-paying name, real estate, defensives, healthcare, all the laggard for the week. Looking at the breadth on Friday, pretty good. NYC, 73% advancing versus 26% advancing. NASDAQ, 69% advancing versus 28% declining. And even if we look at the 52-week highs versus lows, all positive in the NYC and the NASDAQ. So the breadth, all in all, was inclusive. As I said in the morning, once the data was out, and we've seen some hedging based on a weaker payrolls being taken off the table, and that was the VIX going down. The algos reacted by saying, okay, VIX down equals I'm going to buy the futures. Without really thinking about the themes or bond yields going higher, what does that mean? Should I really pump the Russell 2000 the same way I'm pumping the Dow Jones or the SPY? There was no thinking at all. It was just algorithmic in nature. And this is why we see good breadth. The question is, will it last into next week or no? Is it going to be a trap? So you look at the heat map for Friday, pretty much everything is positive. But again, with higher yields, we have proper responses here. And that comes from the home builders. They're all down for the day. That comes from real estate. Most of them were down for the day. That comes from utilities. Most of them, the big names, are down for the day. The only thing that goes higher is the AI nuclear energy theme, like CEG and GEV. Those are the bigger names. But owning the ETF, the XLU will give you broad coverage to the AI theme within utilities or the recession theme within utilities. But besides that, pretty much everything was positive. Now we contrast all of this with the weekly heat map and you see something different. When it comes to the big caps, mixed picture, but we have a rebound in NVIDIA. The CEO said, we have insane demand. If you have insane demand, then why are you dumping stock? But anyhow, we have Meta, the outperformer. That's in my opinion, one of the few good-looking charts in technology, at least for now, along with Google. But the rest, Microsoft, we talked about this about 2 weeks ago. We did the charts coverage for the weekend video. Microsoft doesn't look pretty good, but Meta, Google do. So now you see Meta up about 5%, Google about 2%, but Microsoft down about 3% for the week. And right off the gate, you see that anything that is dividend paying that's been working out for the last couple of months because we had the recession wind is now the underperformer. We're talking about healthcare. We're talking about the real estate. We're talking about utilities. We're talking about the staples. Even some of the rope/soft landing theme was down. Look at cyclicals, look at the automobile manufacturers, look at regional banks, all down for the week. It was mostly a geopolitical theme in which we see energy shining big time. But of course, even within energy, folks, I've been touting ExxonMobil. That's the only one that I bought recently. Why? Because if we do the themes based on individual stocks, you'll see that Exxon fits the geopolitical theme, it fits the value theme, the recession theme, the dividend theme. It fits many categories. But the other smaller, higher beta energy names, they only go higher if the commodity, oil, goes higher. Exxon has multi-layer plays, and this is why it is my favorite name to play right now. But then you also have in the geopolitical theme, the defense contractors, Lockheed, Raytheon, all leading the way higher. The China theme was still alive. You look at Baba, Pinduoduo, all higher, even though this time around not including the metals because the dollar went significantly higher. But when we say, folks, it is a picker theme, I mean, you look at even healthcare. Okay, the ETF did not do pretty good because there was no love for dividend-paying names in healthcare when you have bond yields going higher. But Bristol Myers BMY is a name that we bought recently in the portfolio, and you see it as the outperformer. This is where the skill of the game really shows up. The lazy dogs who come on TV from all of these firms who just take your money and dump it on the ETF and pretend to be geniuses as the Federal Reserve and the government manipulate the market higher. They have no clue how to invest in an active theme at all. Meanwhile, I think we have the record in this channel that we do know how to invest in an active theme. Looking at the heat map for the week, when we look at the ETFs, once again, most of the ETFs are down. The TLT is down, meaning bond yields are higher. Right off the gate, this is not good for any bond yield sensitive, be it risk on or risk off, all of them are down. The dollar is higher, so anything dollar related is down. But again, the contrast is really important. GDX gold miners down, but GLD gold, the commodity, is actually flat. And this is why we favor buying GLD over GDX. Trade GDX, but own GLD. Why? Because gold, the commodity, fits many categories. When we talk about the themes, of course, the China theme is still alive. FXI, MCHI, EEM were the outperformers for the week, of course, along with energy. XLE, XOP, or so massive gains for the week. The laggards, though, Bitcoin was really interesting. All of these crypto ETFs were down big for the week. I think it also relates to the dollar going higher. And it also exposes crypto as not a safety bet or a hedging bet at all. When you have a recession theme, crypto underperforms. When you have a geopolitical theme, crypto underperforms. When you have an inflation theme, crypto underperforms. We talked about gold being a superior asset versus Bitcoin. Looking at commodities, the closing on Friday, positive for crude and Brent despite the manipulation by Joey B. Even heating oil, diesel was up about 1%, but nat gas gave up some ground, about 4.5% to the downside. But again, you can look at the charts, it was a little overbought. Mixed picture in the rest of other commodities, in softs, in metals, in meats. Grains were down for the most part on Friday, but again, we look at the week all in all. You can see the crude was up about over 9% apiece. Gasoline RBOB up over 8.5%. So again, when you talk about the inflation wind, when we talk about the Fed making a huge mistake, the market speaks the loudest, and it says, wait for it, reinflation is coming. And again, they're going to blame the rise in crude oil on the geopolitics and all of that. We've been under the geopolitical risk for over a year now, if you count in Russia-Ukraine. This is a combination of multi-tailwinds for crude oil, including the geopolitics, but most importantly, the Federal Reserve easing when they shouldn't. Moving on to the big casino options, what do we see here? The volume remains concentrated in Nvidia, Tesla. It increased higher in AMD, mostly buying calls, and this is why the stock went higher by about 5%. But besides that, the volume is dead, folks. What I look at, of course, is the IV rank. So last weekend, we talked about Tesla. The IV rank was about 100. I said, look, sell the news. When you have the IV rank at 100, while the stock been going higher, ahead of a certain piece of data, you're going to see sell the news. Because the implied volatility is way too high, you're just handing your money to the market maker if you're buying calls at that point. So we've seen actually Tesla going down for the week. Even though it did close positive on Friday, the IV rank right now sits at about 80%. We know that we have the robo-taxi event, I believe, Wednesday. So right now the call's not as expensive as last weekend, meaning Tesla has the probability, depending on the event, of going higher. But the way I would exploit it is buy the calls Monday, Tuesday, all the way till the event, and then dump it before the event comes out. Now, if you look at Alibaba with the IV rank at 100, a lot of folks are assuming that once Shanghai opens, we will see all of this massive pin-up demand showing up and Chinese equities will explode higher. Maybe, but I would actually say the smart hands that were already buying China when we talked about buying China will actually begin to book profits while the weaker hands pile in. At some point, the dip will be bought and higher we go. I think at least the initial reaction will be profit-taking after the holiday in China. And the fact that Alibaba at 100% right now gives me the probability, really high probability, that it's gonna pull back. Now, if it pulls back Monday, it might head higher once Shanghai opens Tuesday. So if it stays flattish or it goes higher again on Monday, I would say the probability or the odds will be in favor of a pullback once Shanghai opens. When we look at the flows on Friday, we're talking about the net flows. We don't do the buy and sell flows separately because we confuse the living hell out of you. So we're just going to do the net flows here, bullish flows for Carvana, TIGR. Huge pump over the week, and some of you caught it in Discord. I think it's time to book profits, to be honest. If you didn't book profits Friday, I don't know what you're waiting for. Microsoft, Qualcomm, TLT, bonds, not sure how that's going to work out. The Qs, YINN, this is the triple bullish ETF on China. Then you have the bearish flows in Coinbase, ASHR China, TMF bonds, EM emerging markets, KWeb, FXI. So you see that we have bearish flows against Chinese equities as we anticipate the reopening of Shanghai. And I agree with it. And I said repeatedly in Discord on Friday, I think once we open in Shanghai, we see profit taking, not the pent-up demand. We'll see what happens. But let's talk about the unusual activities that we got on Friday. You'll see an interesting theme of the indecision. So when I say, hey, maybe the action that we got on Friday was a trap because bond yields went higher, a lot of stuff that went higher like the IWM shouldn't have. And you're going to see this debate happening right here in the unusual activities. We begin with an obvious theme here, which is crude oil, the anticipation of the Israel-Iran response. So here we have somebody who bought USO bull calls. They bought the 80 calls and they sold the 84 calls for the expiration date October 11th, spending about $2 million. Now, they're only going to get rewarded here if we have a strike happening before the expiration date because they bought way out of the money. But this is here what I'm talking about, the debate. Some folks think that when China reopens, higher we go. Others believe that down we go. Some folks believe that when Monday opens, the stuff that went higher, despite the fact that we have higher bond yields, will continue to go higher. Others say no, we're going to see an opposite reaction. So pay attention here to these kind of bets. We begin with JD, China theme. Here's the bullish one. Somebody bought the 47.5 calls, the expiration date Jan 17, 2025, spending about a little over $1 million. But here we have the opposite play. Pinduoduo, somebody actually buying the puts, fading the rip. The 150 puts, expiration date November 22, 24. Spending about $9 million. Then we have EM, the emerging market ETF. Somebody also buying a bear put spread. They bought the 46 puts and they sold the 43 puts for the expiration date November 15th, 2024, spending a little over $1 million. Now, obviously the bullish trade for JD goes for a longer expiration date. The bearish ones for Pinduoduo and EEM go for a shorter expiration date, so maybe an initial pullback, but then you look back a few months from now, and Chinese equities will be much higher. And I do agree with this kind of assessment. But you see it here in the video too. Here's the bullish one. Somebody bought the 131 calls, the expiration date October 11, spending a little over $2.5 million. On the other hand, somebody bought the 120 puts, the expiration date November 22nd, spending about $1.25 million. So when it comes to NVIDIA, again, no conclusive answer. Some folks think 130 by this week. Others think no, below 120 by November. You look at the IWM, here it is. The bullish one, somebody bought the 220 calls for the expiration date October 11, spending a little over $1 million. On the bearish side, somebody bought the 216 puts, the expiration date November 1st, spending about a little over $1.25 million. So go figure. As I said, I'm not the only one who's debating the move on Friday, whether it is legitimate or not. That we start with the, let's say, more confident themes. We begin with the bullish one for Tesla. Somebody bought the 250 calls with the expiration date October 11, 2024, betting on the robotaxi event, spending about $5 million. I would do it, but like I said, Monday, Tuesday, then dump it before the event. Maybe the better bet, by the way, as you head to the event, is trading Uber, because Uber will be impacted, positively or negatively. But the options for Uber, way cheaper than Tesla. What about the bearish unusual activities? How about the TLT? Somebody bought the 86 puts for the expiration date March 21st, 2025. It goes against a lot of folks, especially here in this channel, who've been buying the TLT. And I said, look, I think you're going to be right in the long run, meaning a year or 2 years from now, that the Fed will have to ease because the inevitable destination of the economy is a recession. But it's not going to be easy. You're going to be stuck in this trade or investment for a long time, and you might need to average down. So time is of the essence. And maybe while you're waiting for the TLT to go higher, some other themes are playing out. And if you look at this trade right here, somebody betting all the way till March of 2025 that the TLT will actually go down and bond yields will go higher. I see no other scenario that could lead to this besides reinflation. In any case, they spent about a little over $1 million on those puts. Then we have a quite an unusual one here for AAL American Airlines. All of the airliners been outperforming as of late, but somebody fading the rip here. You got to remember, earnings are coming out soon. Somebody bought the 10 puts for the expiration date March 21st, spending about a little over $3.5 million. And then we have the RSP, the equal weight ETF for the S&P 500. Somebody's fading that too. They bought the 165 puts for the expiration date December 2024, spending about $1.5 million. And then we have the ITB, the construction ETF. Somebody bought the 120 and the 110 puts for the expiration date November 15th, spending a little over $1 million. Now, the ITB and the XHB would continue to suffer if bond yields go higher, indicating that mortgage rates will go higher. We're going to see a slowdown in the housing market. What about SMCI, Supermicro? The stock already split. They split it organically by the crash, but the split took over anyways, and now it's going to become a gambling casino. And it's going to attract a lot more bears than bulls. So not a good outcome for the company or the stock. Here we have somebody bought the 36 puts for the expiration date Jan 17, 2025, spending about $1 million. Then we have Microsoft. The chart doesn't look good, the weakest among the big caps. And somebody betting on it here, buying the 410 puts for the expiration date Jan 17th, 2025, spending about $1.5 million. Let's move on, do some charts, and then wrap it up here, folks. We begin with the SPY, the S&P 500 hourly chart. What do we do with this guy? We've been consolidating here for about 2 weeks, doing nothing at all. The Fed cuts rates and then we're consolidating in a range. Does it appear that the higher odd is for the energy to be released to the upside or the downside? At least based on the closing on Friday, it appears to be the upside. But it's hard to say. If it was a trap on Friday, then down we go within the consolidation range again. At some point, somebody got to give up. Either the folks who are already in, they're going to book profits and lead us down, or the folks waiting on the sidelines will capitulate and buy. Was the employment data what they were waiting for to hop in? I doubt it. So when we look at the daily chart for the SPY, the S&P 500, again, the bull to bear advantage line 562.48. So long as we're trading above, the upside bets have better odds than downside bets. But again, folks, we're losing momentum in the MACD, in the RSI, in the Forex indicator. Friday, of course, an anomaly because it pushed us higher again. If we don't see a follow-up Monday, then it was probably a trap and bond yields are heading higher, so a lot of the SPY components not going to like it. Now we look at the weekly chart for the SPY. Once again, we talked about the wave extensively before. That the wave is coming to an end. It's just a matter of time. We're still trading within this rising wedge pattern. But what's really imperative here is we study the look in the momentum indicators that we have right now versus the top in 2021. Before you jump the gun, because this could take a little bit of time, you see the negative divergence that we have here in the weekly MACD and the negative divergence that we've seen in the SPY in 21 heading into the bear market in 22. Now the SPY managed to go higher despite the negative divergence that we see in the MACD indicator. But the beauty of the Vortex indicator that you see at the bottom, that it's so lagging, it gives you the best confirmation. And we only got the confirmation that it's over. This is the time where the wave ends. Once the Vortex indicator, the red line crossed above the blue. That was the moment. So right now, we don't have that look yet. When you see it, you'll know that we have a confirmation that the wave is over. Looking at the Q's hourly chart, same thing, consolidating within a range. We can't really do anything about it here. We need to get out of this range before we have a conclusive evidence that the folks on the sidelines stepped in, they're going to head us higher. Or the folks who are already in, they're going to book profits and head us down. If we look at the daily chart for the Qs, once again, in no man's land, we're just consolidating right here. Momentum indicators are getting weaker. As you can see in the MACD, and the Vortex, and the RSI, they're all wanting to head down. But then came Friday's action. So we have to wait for a confirmation. Was Friday a legitimate pop, or was it just an algorithmic pop, and down we go after that? What we know for now is the bull to bear advantage line is 484.84. And since we closed above, the upside bets have better odds. But keep in mind, it's really close. And this could be at the end of the day a topping head and shoulder pattern if we head down with no confirmation of what we got on Friday right after the open Monday. If we head down, more likelihood that it's going to be a confirmation of the topping head and shoulder. And now, if we trade below 484.84, the downside odds will gain significant advantage. On the weekly chart, what do we see here in the Qs? The trend line remains intact, but this one is a lot closer than the SPY. We have negative momentum showing up in the MACD, and the Vortex indicator is about to give us confirmation, so the Q is certainly weaker than the SPY. And two important numbers you got to keep in mind. Of course, the top from July, if you trade above, most importantly, you close above for the week, it's a more solid confirmation that higher we go. But then you got 448 on the weekly chart. If we close below, that it guarantees that the top is already in, the trend line will be broken, and the bull wave in the Qs is over. So that's an important number to look at. Right now, since we're trading between, there's no advantage one way or the other. Somebody got to make up their mind. The IWM small caps daily chart were above the 20 days moving average, so that's the bull to bear advantage line, just like we've seen with SPY and the Qs. Friday kind of scrambled everything. Is it fake out? Is it legitimate? Is it not legitimate? We'll see what happens on Monday. If we open down, we take out the 20 days moving average again. I would say double down in the shorts on the IWM if you got them, because it's only going to go down because bond yields are going higher. And all of a sudden, the human being shows up and says, the algorithmic reaction that we got on Friday was not legitimate. Bullish confirmation. If we take out the sloping line of resistance, if we close above, then you know we're heading back to the upper Bollinger Bands, right now 226. The dollar, we talked about the falling wedge pattern. We got the breakout. But now what? We're at the upper Bollinger Bands. Either you see the flare up in geopolitics, or we see the dollar continuing to get a bid, or we see a pullback. And if you see a pullback, you have two more important events to look forward to. Obviously, the geopolitical event, the strike against Iran. That's going to push the dollar higher again as a resource of safety. But what about the CPI comes out Thursday and the PPI Friday? If those come out hotter than expectations, then the dollar is going to continue to go higher. And at some point, even gold is going to give up and pull back. You see, if you look at gold futures right now, holding pretty good. But boy, if the dollar goes up again this week, there's a point where it has to pull back. And if we lose 2,600, then I would say, okay, something else is going on. Now we got to hedge aggressively in gold. Besides that, a pullback to 2,600 is, I would say, long awaited because it's going to give a lot of folks the entry point. In the meantime, as I say week after week, I hedge my GLD using GDX puts or SLV puts. Right now, if you look at the weekly chart for the SLV, it actually looks pretty good. But maybe it needs to go down for, let's say, a week or two as the dollar continues to go higher and form somewhat of an inverse head and shoulder pattern before it heads higher again. But the point is, SLV puts are really cheap. So if you own gold, you buy the SLV puts for the week if you think the dollar is going to go higher or there's a catalyst for the dollar to go higher. And that's going to protect you at least all the way till the end of the week. What about crude oil? What do we do with this guy? The good news, we're above the sloping line of resistance. Number one. Number two, we're above 72.48. We closed above that number. That's the good news. The bad news, are we a little overextended outside of the upper Bollinger Bands? Yes. Meaning, if you get sell the news in the geopolitics, where Israel magically says, you know what, we decided to forgive Iran for what they've done. Or they do a lame airstrike in the middle of the desert and nothing happens. Or we'll see a drop in oil, no doubt about it. But if we're just anticipating the response, then we dip down Monday, maybe Tuesday, then the response will happen. Because I said, my information tells me that it's going to happen U.S. prime time, Monday. If it does, then maybe you'll see a pullback in the middle of the session. But then overnight, we see crude going higher again. If you look at the weekly chart for the 30-year bond yield, folks, once again, it looks to my eye, if you look at the MACD indicator, for example, that we're going to head higher, that maybe we have a double bottom here in the 30-year bond yield. We're going to break above the sloping line of resistance, and we head higher, above 4.4, maybe 4.5 in the 30-year bond yield. What do you think that's going to do with mortgage rates? Imbecile Powell, by cutting rates, tightened financial conditions. Unbelievable. And if you look at the daily chart, you zoom in a little more. Do we have an inverse head and shoulder pattern here? I think so. So what do we do with the XHB home builders? You know that we got the bearish trade, and I said, you see the scissors here, that's the cut loss. If we have a close above 125, you know that we're heading higher. But right now, the good news is confirmation on the MACD indicator of a shift from bullish to bearish in the momentum. But we did not close above or below the 20 days moving average. That would have been another good confirmation. Maybe it's going to happen Monday. If it does, then we have further downside in the XHB and we'll manage the trade accordingly. Maybe we close it and book profits, maybe roll and expand, and we buy the 117 this time around and we sell something below. We'll update you in Discord. Fingers crossed that we open down in the XHB. What about the IYR weekly chart? As I said, with bond yields going higher, you don't need the dividend-paying stocks for now, so we see folks booking profits and the IYR going down. If, as I anticipate, the 30-year bond yield heads higher, then the IYR should pull back all the way to the 20 weeks moving average that it got. That's going to be in or around, let's say, 93, 94 at the time when it reaches there. And that's going to be a consolidation range too. So I still see a pullback coming for the IYR. Here's the confusing part though. The IWM and of course one of its biggest components, the KRE regional banks. Thursday, we get a confirmation that down we go, we broke below the 50 days moving average in blue. Comes Friday, despite the fact that bond yields are going higher, the KRE closed above the 50 days moving average. Now, technically, you have a bullish confirmation. I think it could be a trap. And this is why I want to see what's going to happen Monday. If we lose the 50 again, we're back on track. KRE is heading down. If we have a follow-up and we close positive again, there's something different is playing out. The volatility index, VIX 4 hours chart, what do we see here? Despite the so-called good news with the payrolls, it is still trading above the bull-to-bear advantage line, meaning you trade above 1760. The bearish bets on the market have the better odds. And the pullback wasn't that big, to be honest with you. We just closed the gap, and that's it. So I think that the VIX could be heading higher again this week. And if it does, we have the geopolitics as a catalyst. We have, of course, the CPI and the PPI. If those come out as a beat, then you're going to hear a lot of the soft landing bullshit narrative that we got this week flipping to, oh, maybe the Fed cut too soon and too much. And you might even hear rate hikes again. Keep that in mind. Big Kahuna Apple daily chart. Consolidation pattern, no break one way or the other. We had one false break forming a double top. If you look at the momentum indicators, the odds say we're probably going to break it to the downside. But I think everybody's waiting for the revelation of the AI features for the new iPhone before they make up their minds. If you look at the weekly chart for Apple, consolidation pattern, as we see with the SPY, with the Qs, not making up its mind yet. But the odds say, looking at the MACD and the other momentum indicators, that the break will probably be to the downside. We look at Tesla. What do we see here? We got to pull back as we anticipated because of the high IV rank. So when we got the deliveries, it was sell the news. Can we go down further? Yes, we can. But the confirmation will be if we plug in the Bollinger Bands, closing below the 20 days moving average in white, which we don't have yet. And remember, they're going to speculate all the way till the robo-taxi event. We might go back higher to 265.13 again. And if we do, I would say the odds of sell the news again will be highly likely. Now, if we look at the weekly chart for the souffle, closing above or below the 200 weeks moving average, the answer is above. So far, so good. If we close below, forget about it, down we go in a big way. And of course, the catalyst will be a bust from the robo-taxi event. Now, looking at the hourly chart for NVIDIA, anything we can do here? Not really, because absent of a close above 125, that's the bullish confirmation line, we can't do anything about it in terms of the long side. And absent of a close below 115, the bear confirmation line, we can't really short it. It's in no man's land. So now we'll look at the weekly chart for NVIDIA. Same look as at Apple, as the SPY, the Qs. Lack of decision making. What are we waiting for here? I think the earnings season. And lastly, tulips, Bitcoin. Daily chart may be showing a bear flag pattern. Maybe we go down at this point. Sure, with the dollar going higher, of course, you're going to see Bitcoin going down. But for me, no trading here because I'm looking at the weekly chart. I'm going to go long Bitcoin if we break above the bullish confirmation line, which is a close above the sloping line of resistance in yellow. I would go short in a big way if we close below the 50 weeks moving average, which is my bearish confirmation line. And lastly, moving on to the conclusion of this video, what do we have on the economic calendar this week? We begin Monday, October 7th. Of course, all eyes on the geopolitics and the response, but on the macroeconomics calendar, she's looking pretty good right now because the inflation risk is higher. I know that the other zombies will spin it into, oh yeah, that's a confirmation for soft landing. We did the right thing. We're cutting rates just because inflation is going down. I think they're pissing their pants right now. And I think Governor Bowman looks pretty good because she was the only dissenter from the 50 basis points rate cut decision. So we'll hear what she has to say. But we also have consumer credit and San Luis Fed President Alberto Mazzalim. Tuesday, October 8th, we have Governor Kugler and NFIB Small Business Optimism Index, the trade deficit, and more Fed zombies from Atlanta Bostic and the Vice Chair Jefferson. Comes Wednesday the 9th, again, with Atlanta Fed Zombie Bostic, followed by Dallas Fed Zombie Logan, and then Chicago Fed Zombie Goolsby, and again the Vice Chair Zombie Jefferson, and the zombie from San Francisco Daily, But as to the macroeconomics data, we only have wholesale inventories. And then the minutes from the September FOMC meeting, which now will be more important than ever, to go back and review why did they go with the 50 basis points when it wasn't needed at all. Was it a political decision? A lot of folks are speculating that way. I think the Fed fell into a trap, to be honest with you. Anyhow, Thursday, October 10th, we have the most important day for the week. From a macro perspective, of course, initial jobless claims, and then the CPI, aka the CPLI. And then we have more Fed zombies, Lisa Cook, Tom Barkin from Richmond, and the zombie from New York, John Williams. On Friday, we conclude by the PPI, the Producer Price Index, and the preliminary rating of consumer sentiment, and more Fed zombies from Chicago Goolsby, Dallas Logan. And then we have Governor Bowman. I'm not going to call her a zombie because she displayed that she has some brain cells still working. Anyhow, folks, that concludes the market coverage for the week. We meet again for the macro coverage tomorrow and more market coverage for the members. If you enjoyed the show, please return the favor. Press the like button, leave us a nice comment, and subscribe to the channel. Better yet, join us as a member here on YouTube or Patreon. Once again, folks, appreciate all of you, love all of you. But this is all I got for you for tonight. Thank you for listening, thank you for watching, and I will talk to you again tomorrow. Good night.